The following of the balance sheet of X Company Limited as on 31st December 2009. Liabilities: equity share capital 10 rupees each, 1 lakh; 12% preference shares 100 rupees, 1 lakh; general reserve 60,000; profit and loss account 40,000; 15% debentures 1 lakh; creditors 80,000; assets goodwill 50,000; building one goodwill 50,000; building 1,50,000; plant 1 lakh; investments 10% stock of materials face value 48,000; stock 60,000; debtors 40,000; cash 10,000; preliminary expenses 22,000. Total 4 lakhs 80,000. The ascertain the value of each equity share under fair value method on the basis of information given. Assets are revalued as building 3,20,000, plant 1,80,000, stock 45,000, and debtors 36,000. Average profit of the company 1,20,000 and 12.5% profit is transferred to general reserve. Rate of taxation being 50%. Normal dividend expected on equity shares 8%, whereas fair return on capital employed 10%. Goodwill may be valued 3 years purchase of super profit. Calculation of goodwill. Total net assets building 3,20,000. Total net assets 3,20,000. Building 1,50,000. Plant 45,000. Stock 36,000. Cash 20,000. Totally 3,15,000. 3,50,000. Less current liabilities creditors 80,000. Can we get the capital employed? Capital employed 2 lakhs, 3 lakhs 11,000. 3 lakhs 11,000. Net profit net profit 3 lakhs 31,000 into 10 by 100. Actual profit 1 lakh 20. Average profit 20,000. Net assets debenture issues 11,000. Profit debited average profit 1 lakh 28,000. 1 lakh 28,000 less outstanding amount 5,000. The debentures issue 15,000. Paid dividend 12,000. Taxation 8%, and transfer to reserve. Actual profit, super profit is equal to actual profit into national profit to 51,425, 51,300, 5,525. Value of goodwill 525 into 3 years, 1650, 1575. Valuation of shares, assets backing method, sundry assets 5 lakhs 11,000. Income add 40,000, add goodwill 1,600, 5 lakh 60,000 totally. Funds available to equity shareholders. Share, share value is equal to 5 lakh 60,000 by 10, 56.06. Yield basis value of share is equal to rate of dividend by normal rate of return into paid up share value. 8 by 10 into 10, 8 rupees. Number of the preference is in the problem There was no apply the based on the dividend basis. So fair value is equal to assets backing method value plus yield share is value by 2. 56.06 plus 8 by 2 is equal to 32.03. Assets taken fixed assets 7 X limited assets taken X limited fixed assets 7 lakhs, investments 3 lakhs, current assets 2 lakhs, totally 12 lakhs. Current liabilities debentures 10,000 1 lakh, creditors 1 lakh, totally 2 lakhs. 12 lakhs minus 2 lakhs is equal to net assets 10 lakhs. 10 lakhs by intrinsic value of share is equal to 10 lakhs by 50,000 is equal to 20. In the same way, Y limited fixed assets 10 1 lakh, there is no investments, current asset 50,000, totally 1 lakh 50,000, current liabilities minus current liabilities creditors 50,000, totally 1 lakh 50 minus 50, get the 1 lakh. 1 lakh by 10,000 shares is equal to 10 rupees. Valuation of goodwill. What is goodwill? Goodwill is the excess of purchase of power over share of net assets. Goodwill is intangible asset. Goodwill is reputation, higher earning of income, etc. Goodwill is equal to purchase price minus fair value of net assets acquired on the date of purchase. Methods of valuing goodwill: super profits method, capitalization method, annuity method. Super profits method. Super profit is into number of purchases. Super profit is equal to future maintainable profit to normal. Super profit divided into two types: future maintainable profit to normal profit. Normal profit are divided into two types: capital employed, normal rate of return. Super profits method. Normal profit is equal to capital employed into normal rate of return. Super profit is equal to FMP is equal to normal profit. Goodwill is equal to super profit into number of purchase. Capital employed is equal to shareholders fund approach. Assets side approach, liability side approach. Consider long-term debit as liability. Long-term fund approach, asset side approach, liability side approach. Consider long-term debit as capital employed. Capital employed, shareholders fund approach, asset side approach, liability side approach. Considerable long-term debit liability. Long-term fund approach, asset side approach, liability side approach considers long-term debit as capital employed. Long-term approach, asset side rule, fixed assets, trading investments, current assets less current liabilities, capital employed. Liability side approach, equity share capital, preference share capital, reserves and surpluses, long-term debit less non-tradable investments, miscellaneous exhibit non-return of capital employed. Trade investment should not form part of capital employed. Non-operating assets. Example: fixed deposit land, which is fixed deposit land which is not used for business and do not yield any income. Capital employed represents the fair value of net assets invested in the business for carrying profits. Investment in a associate, subsidiary, or joint venture is considered as trade investments. Deduct non-trade investments, ignore non-trade investments. Liability side or asset side. Shareholders fund approach, asset side rule. Fixed assets, trading investments, current assets, less current liabilities, long-term debit, capital employed. Liability side rule: equity share capital, preference share capital, reserve surplus, minus non-tradable investment, miscellaneous or not except not written off. Capital employed: asset side approach prepared capital employed it to be calculated on fair value. Don't consider book values while calculating CE on a fee basis. Capital employed, closing capital employed, average capital employed. Average capital employed are divided into two types: closing capital employed, average capital employed. Average capital employed, OCE by CCE by 2, OCE by OCE plus half of the current year profit, CCE CCE minus half of the current year profit. OCE, opening capital employed. CCE means closing capital employed. Opening capital employed plus closing capital employed by 2. Opening capital employed plus half of the current year profit. Closing capital employed minus half of the current year profit. It is assumed that profits are earned evenly during the year. Treatment of proposed dividend. Proposed dividend is employed in the business throughout the year. Proposed dividend is current liability, but it is appropriated from profit and loss account. Therefore, treat proposed dividend as a capital employed. Treatment of provision for taxation: we pay taxes from the advance tax. It appears to be appropriate from profit and loss account. Actually, this is not employed in the business, as money already gone in from advance tax, not considered as capital employed. Future maintainable profits, FMP, trend method, average method, weighted average method. By taking past year's profits, apply any one of the above tools, then we can find FMP. Weighted average method is used when there is up or down trend. Recent years should be given more weight. Adjustments to be made to profits while calculating FMP. Extraordinary items in non-recurring items should not be considered. Abnormal items should be eliminated. Income from non-trade investment should be eliminated. Adjust for any change in occurring accounting policy. In case of change in tax rate, add back already paid tax, reduce tax payable in future. All above the changes should be made on the yearly profits after adjustments. Adjust special future changes. Capitalization method, normal capital employed, actual capital employed. FMP, future maintain future maintainable profit method, profits, normal rate of return. Capitalization method: goodwill is equal to normal capital employed minus actual capital employed, NCE minus ACE. NCE is equal to FMP by NRR, or goodwill is equal to super by normal rate. Annuity method or super annuity value. Super Number of years purchase, crystal clear, NCT not clear, crystal clear, not clear. Annuity method, capitalization method. NRR can be calculated under the also not directly given in the problems. NRR is equal to of 1 by PE ratio. Closing capital employed versus average capital employed, capitalization method. Under this method, Closing capital employed should be taken for calculation of goodwill unless the problem specifies the requires application of average capital employed. Superprofits method. Under this method, closing capital should be generally applied except in the following situations. Specifically asked in the problem, information about opening capital is given in the problem. No changes prescribed in the problem for closing. Capital employed and FMP is calculated purely based on the past profits without adjusting for the future changes. Capital employed two routes, two approaches, two methods. Assets and two routes, assets and liabilities. Approaches SHF and LTF. Methods ACE method, CCE method. Is enough.